welcome to the UKMBA webinar, which is our chance to update you on the progress of the Municipal Bond Agency. Part of it is obviously for quite a number of you, you may not be too familiar. Many of those joining today very happily are actually not shareholders, and we haven't been engaging directly with you very much recently. So this is informative, but underlying this is that we are going to proceed with issuing our first pooled bond in September, and there is a process to be gone through to get councils that want to participate in that to go through the decision processes that you may need to, and we'll deal with that very shortly. So, we are moving towards a bond issue, our first pooled one, as I say, and we're going to be focusing on what is necessary for those to participate in that, as well as informing you of onward bond issues beyond that. And to do that, you'll be hearing very shortly from Christian Wall and June Matty from our colleagues PFM, who operate UKMBA day by day, and they're going to be presenting that to you. We're also going to be hearing from Mike Jensen, familiar to very many of you, from Lancashire County Council, and he'll be talking about the first single authority, Lancashire Authority bond issue that we completed in the early days of lockdown very successfully, and Mike will talk about that, and indeed further likely interest from Lancashire. And Adrian Bell, UKMBA Deputy Chairman, will be talking also about the current market conditions, his experience in bond markets, and how that may play out over the next few months. Just from me, I guess the context that we're all familiar is not only COVID-19 and the constraints and difficulties of that, and the impact that's having on council's cash flow, but also we've got the PWLB review going on at the moment. That's been extended, the consultation, till the end of July. I believe some idea that there may be some form of roundtables or workshops in that, though I'm not aware if any of those have been fixed yet, or quite how that will be handled. And I think we'll be touching on whether you should be putting all your cards on the outcome of that taking us back to a world we're in before, and I think a great deal of skepticism, certainly from our point of view, whether that's an accurate expectation, but also the wider context of the sovereign rating of the UK, and whether that might change in the autumn due to obviously views by the rating agencies about UK's overall financial position. So that's the sort of immediate context, but now I'm going to hand over to June and Christian to take you through the presentation. Just to say, we hope to have this completed by 1 o'clock. We are recording, and that will allow us to send you a link, and indeed others to share a link for those who want to hear what we've been discussing over the next few days. When we get to questions and answers at the end, we're not going to be using the Q&A screen on this application. We're going to be using the chat facility, and therefore we'll ask you to click on that and to write your questions in. With this number of people, it's difficult to do it any other way. So that's, I think, the structure of the day. We've currently got 28 attendees and 6 panelists, and I'm going to pass on, as I say, to June and Christian.
Afternoon, everyone. Apologies to some of you who may have seen some of these slides before at the AGM, but what is different this time, we actually have Mike Jensen on to talk about Lancashire and his experiences of the UKMBA, and also Adrian Bell, who's the Vice Chair of the agency, to give some market flavour. So towards the end of the presentation, there are definitely some new things that we have to say. In terms of content, we'll run through again the agency's business case, what we're doing, i.e. the bond issues, how some of the agency works, particularly around the guarantee, the proportional guarantee. There's been lots of discussion. We'll talk about some of the other products the agency is offering, then we'll hand over to Mike, then Adrian, a quick recap, and then we'll do questions at the end. As Sameric said, if you have any questions and you're not sure you'll be able to remember them, if you put them into the chat box, we can scroll back up and find them. Starting with the business case and validation, the key point about the UKMBA is it was set up to be owned by local government for local government, and it was to reduce the dependency of local government on the government and the vagaries of public policy, primarily around the PWLB. For those of you that have been in post for a long time, which I think is a fair number of you looking at the attendance list, we've all got 15, 20 years now of the PWLB rates being changed, the terms and conditions being changed, the margins being changed. There is something to be said for the independence of the sector. It was also to have a cost-effective and transparent funding alternative to the PWLB. Mike will talk a bit more later about some of the alternatives that are around at the moment, but in general terms, the agency is very transparent and its pricing will probably be lower than some of your advisors elsewhere have led you to believe. The agency's business case came out in 2014 and 15 as it was updated. The actual arguments, including sector independence for the agency, were quite clear. It was to protect councils from the PWB changes, it was to deliver savings to local authorities, to provide fully transparent financing, reduce risky and excessive borrowing. For those of you with that may remember, the LGA had a working group at the time, and one of the things that was starting to cause a lot of authorities concern was the level of risky and excessive borrowing. It's also what the government's concern is now. Now that won't go away anytime soon, but the agency, as we'll discuss later, does do some things around that. We'll tailor products to suit local authorities' needs rather than what suits the provider of the finance, and it's to generate economies of scale. With 343 principal English authorities, every authority doing their own thing means it will be more expensive. Everyone would need their own legal documentation. So that's where the economies of scale come from. So to recap, the agency believes that the business case has been validated. The PWB rates did increase by a whole point last October, and the future's uncertain. The UKMBA has delivered savings, as Mike will discuss. Certain complex products are coming to the fore again. Everybody remembers Lobos, but there are other alternatives, particularly around income strips, if you've had people in touch with you that are not simple products by any means. Some councils have very excessive risky borrowing. That's probably contributed to the PWB changes. The pricing in many alternative loans is often poor. It's rarely transparent, and the value for money is unclear. Again, I'll touch on some of that later, as I no doubt Mike will. With the 50-year gilt at 0.45%, people seem to forget that the PWB margin actually quadruples the cost of long-term borrowing. 1.8%, which is what most of you are paying on top, is an awful lot of premium to be paying, and we're very confident we can beat that. We'll come on now to where the agency is in terms of its medium and long-term bond issues. We've had discussions with some of you within the sector, and essentially we have demand around 3 maturities, roughly 10-year maturity, 20 to 25 years and 40 to 45 years. Now we'll fix the precise maturity as borrowers come forward and everyone agrees what the exact maturity they want is. What we do need as an agency is clear demand to proceed with a particular bond issue. Now, essentially, we will go with them whenever there is sufficient demand for us to place a benchmark bond, which is around about 250 million. That's the aim. So if the first one is 10 years, we'll do that. If the first one is the 40 to 45 years, we will do that. We need confidence that authorities will participate. What we can't have, and has actually happened to the agency once before, is we get the week of launching the bond issue and somebody pulls out. So the agency will be looking for people to actually commit to borrowing. Now that will always be subject to the rate being lower the PWLB. So were the PWB to cut rates at some point while the process is being undertaken, the bets are off. So you're not going to be hung up paying more than you need to if the PWB does cut its rate. Having said that, the agency can only proceed if there are commitments to participate. The borrowing councils have approved the framework agreement and the agency is asked to begin its credit process. Not everybody has the automatic right to borrow from the agency, and we'll discuss a little bit more around the credit process later. In terms of timing and pricing, contrary to what some people have been telling you from not disinterested advisors, the agency needs only 8 weeks to place the bond from demand being identified. It's not 12 and it's not 16. Now, the bulk of that is actually taken up by Moody's. Moody's will rate the agency and they will rate the agency's bond issues. It's important to stress that they're not rating the underlying council, so you're not going to have Moody's knocking on your door if you borrow through the agencies, nor are you going to have to pay them for a credit rating. But having said that, that also means that local authorities need to meet those deadlines. So if you need to sign the framework agreement, we need that signed during the first 6 weeks that we can launch the bond issue. Now, over time, the agency's timescales will shorten. I would be very surprised if we're half a dozen bond issues under our belt. We're not issuing in 4 to 6 weeks, and over time it will probably be a 2-week lead time. Pricing will depend on maturity. At today's rates being fairly conservative, but still a little bit positive, we think we'd be gilts plus 85 at 10 years and gilts plus 110 at 45 years. Now, there are suggestions we would come under that at the moment, but we're being fairly honest on where we think we are, and we're not over-promising. It's on the PWLB consultation. It does suggest a cut in the rates, but quite clearly it states any reduction is subject to interest rates. Now, if you remember, part of the logic that was put out for the agents, for the government increasing the PWB margin, was that interest rates had fallen. Ergo, local authorities were only borrowing at rates they would have got in late 2018 anyway. Now, as you all no doubt know, interest rates have fallen. Not only has there been the Bank of England cut, but the gilt rates have fallen. So that's problem number one. The timing is uncertain. The consultation's been delayed. It's now the end of July. The conditions might be unpalatable to some of you. It's very hard to distinguish between what's regeneration, what's economic development, and what's pure profit. And till they're actually set down and people can work through them, check that they're happy, we don't actually know that anyone's going to be able to access a cheaper rate. And there's no commitment to restore rates to gilts plus 80. It's inferred in 1 or 2 places, but there is no firm indication of a cut in the rate. If it's important to HMT that it has control, the easiest way to secure a PWLB cuts is actually to get the UKMBA to issue more bonds, because that's the way that will force the Treasury to do something. If control isn't important, it will not matter, obviously. But given some people have suggested that control is important to them, having the UKMBA out there undercutting the PWLB is probably the best way to get what you want, if that is what you want. Coming on to the guarantee, all borrowers coming through the agency as part of the pool bond programme will have to give a proportional guarantee to the agency. Now, that's much less than the previous guarantee arrangements the agency wanted. So the liability under the guarantee is proportional to the share of outstanding borrowing. So if the agency has £1 billion worth of bonds out there, you've borrowed 10 million and somebody else for 10 million defaults, you would actually having 10 into 990 million. So the liability is much, much lower than it was under the joint and several arrangement, where a bond investor could in theory pursue any single authority for any default on their own. So this way they can't, it's pre-programmed. It's worth reiterating that no local authorities ever defaulted on a debt, which I'll come on to in a minute. Also extends the principle elsewhere in the framework agreement. So the framework and things that are designed to stop a local authority defaulting are all underpinned by proportionality across local authorities. So we're extending that through to the guarantee. It's also, in strict terms, no longer irrevocable. So previously, If the agency had issued a bond yesterday and you had a debt outstanding to the agency you repaid today, you would have been liable under the guarantee till that bond matured, which could be 45, 50 years. Now, as of today, if you were to borrow, you'd been unrepaid today, you would no longer be liable under the guarantee because you owe nothing. Your proportion would be zero. So there is nothing to stop you repaying loans early, for example, if the bondholders will accept that repayment. So there's some myths that are worth debunking. The proportional guarantee does not cover the running agent costs of the agency. They are completely separate. The guarantee is in favour of bondholders and other financial institutions that provide finance. So nothing else are you liable for. There's no debts owed by any authority to anyone else. It's been suggested the guarantee covers the PWLB. It doesn't. It's only in favour of the bondholders and people who've lent money to fund the bonds and the loans that local authorities have taken out. Worth pointing out, because I always get asked this question, London Borough of Hammersmith and Fulham did not default on the loan. What it had been doing was issuing, i.e. writing in common terms, interest rate swaps, and they, would you believe, underpinned 2/3 of the UK swaps market at the time. So what the courts actually did was decide they were actually ultra-virus, i.e. they were illegal, so it unwound them all. So they didn't default at all, and it was not a loan. So it's an important distinction. Because everyone's still entering into a proportional guarantee and there is some risk, and the agency wants the best credit rating possible for the bonds so that you get the best interest rate when you borrow, the agency retains its own credit process. Now, it's important to stress that's actually light touch. We're not going to come in and camp out like Moody's would for a week, discussing arcane bits of your budgeting. Local authorities publish a wealth of information that's out there, and we're just as capable of downloading it and reading it as anyone else. So most of the work is done in the background. We will come back to you when you commit to borrowing and require you to agree the credit assessment with us. Now, that's to make sure we've got things right as much as anything. Now, for those of you that have been writing now for 10 years about austerity and budget pressure, it's not always easy for somebody outside to decide whether that is a genuine budget constraint or whether you're trying to get corporate discipline to get the savings. Now, sometimes we may have helped that wrong in the past. So we'd be looking, for example, for you to confirm that we've got that part right. All of the agency's decisions are ultimately approved by the agency's board. There's no incentive for anybody to game the system here because ultimately it's counterproductive. The agency has to maintain its credit standards, both to satisfy yourselves, you're not running significant risk through the guarantee, and also to satisfy the markets that the local authority is borrowing at the good end of the spectrum, not the very small end of the spectrum. In broad terms, the agency's credit standards are quite high. They are single A in parlance. The UK at the moment as a sovereign is AA2, so it's AA. It may well be downgraded, which will have an effect. Now, we'll look at that when the time comes. But at the moment, no council is guaranteed to pass the process, whether you're a shareholder or not. It's neutral as far as the AG is concerned with regarding credit. We'll talk a bit now about some of the other products that we have on offer, as well as just loans for bonds. One of them is forward rate loans. At the moment, we have a 2-year product. We can probably get that to 4 years. And essentially, that enables you to commit to taking out a loan in the future at an interest rate that is guaranteed. It's always been requested of the agency pretty much since the outset. What it does is give you certainty regarding future funding, particularly if you've got complex regeneration or housing projects that are very sensitive to changes in interest rates. The costs are fully transparent because the agency passes them straight on to you. It cannot be a counterparty for the derivative. It doesn't have the mandate and it doesn't have the capital. The agency is partnering with an investment bank for that product. It's a very well-known global investment bank, so there'd be no problem with the counterparty involved for most of you. We're also offering short-term loans. Now, we're working this program up at the moment and trying to do it as cheaply as possible, and they'll be funded by commercial paper. In terms of the capital markets, pretty much any bond issue less than a year is actually called commercial paper. So that's the distinction. It's 1 year or under. The prime purpose of it is to allow a council to receive funding from the agency while a bond is ready, or you wait for a different maturity to come through. So if you needed money in September while the agency readied a 45-year bond, we would get that through the commercial paper market. It's actually a very cheap way to do it. There's no need to commit to a long-term loan, though obviously that is the agency's objective. The borrowers will still be subject to the agency's credit process. So what we won't be doing is indulging people's ultra liquidity problems. You know, if you have a liquidity problem and you're thinking of a Section 114 notice, you should be talking to the government. The agencies cannot legally lend you the money in that situation, as you know. There's no need to sign the full framework agreement, so it's outside the proportional guarantee, it's outside the other arrangements in the framework agreement. So you will receive quite a short, by relative standards, commercial loan agreement. We think it will be available from late July. It will possibly be August, simply because we need to get the programme rated by the rating agencies, and we need to make sure the costs are affordable for everybody. They will have very short lending timescales. Initially, we think it will be about 2 weeks. That will be down to days within a few months of us kicking the programme off. And commercial paper settles the same day. So if we did on Monday, we said, oh, we'll place some commercial paper, it placed on Wednesday, the chances are you would have the money in the authority's bank account on Wednesday, which is the same timescale as the PWLB. Also offering floating rate debt, which Mike has taken advantage of. The interest rate will always be tied to SONIA now because LIBOR is being phased out, and it's just a fact of life. As Mike will come on to, we've proven that it's cheaper than the PWB equivalent. The PWLB variable rates are actually quite pricey. They've generally been equivalent to a 7 to 9 year fixed rate loan, which is quite bizarre in a falling interest rate environment. They're ideal when interest rates are unlikely to rise or you think they're going to fall, which I'll leave to Mike. A lot of you have heard Mike talk about that in the past in particular, also me occasionally. Treasury advisors, many of them, certainly Arlene Close, have consistently suggested that debt portfolios have some variable rate debt, but hardly anyone does. So we're not reinventing the wheel by offering variable rate debt. We are offering an extra product that for some of you should be or could be very attractive. We also offer standalone loans, which is what we did with Lancashire as an agency. They are at the moment available for anybody that has a borrowing requirement of 250 million or more. We may, in some circumstances, consider less, but it very much depends on what you want the money for and how viable the market is at that point in time. It's outside the proportional guarantee and the agency's credit process. How this actually works is the agency gets the bond issue rated. So it is a de facto rating of the underlying council. Now, Mike at Lancashire already had a credit rating. But if you come to the agency and you haven't got one, although it'll be the bond that's rated, it's effectively the underlying authority. So we are treating it as you as a council will need the credit rating because you will have Moody's in to see you. You must guarantee the related bond issue. That's unavoidable because under the Local Government Act 2003, a lender has various protections afforded to them, and simply by giving the guarantee, they're passed on. They're available for any maturity, and there's various repayment structures available. We could offer amortising loans. We could have a payment holiday if you wanted it, and they can be fixed or floating. So they're quite flexible if you've got sufficient borrowing requirements. Now, with that, I will hand over to Mike to talk about his inaugural bond issue and his views of the market and the PWLB.
Good morning, everybody. I guess I'm not going to tell anybody anything they don't already know, but as is public, Lancashire have been funding their debt positions by short borrowing for a number of years now, after repaying PWLB debt in 2010. And as the interest rate structure in the market had reached, if not the very bottom, but very close to potentially the bottom for the interest rate cycle, we have considered a change to our debt management policy, which effectively, in very simplistic terms, required us to fund a third of our debt in the short term, a third of our debt in medium term, and a third of our debt in long term. For the short-term funding, we wanted the longer maturity, i.e. 5 year, rather than continuing to borrow 3 to 6 months. And we wanted that solidarity of balance sheet that a 5 year note would do. But at the same time, we were very consistently sure that interest rates would continue to fall. So the interest rate structure we chose, as Christian has outlaid, is a floating rate note based on the UK SONIA rate. as LIBOR is being phased out by the Bank of England, although that may get deferred as it has been a number of times already. But the SONIA rate is now the preferred measure for investors in the short-term market, so it was an obvious choice to make. As Christian has mentioned, the bond was issued on a sole counsel basis and supported by a guarantee from Lancashire to the SPV that actually did the bond issuance. So none of these outstandings represent any risk to any other local authority involved in the agency. And it obviously was the first SONIA-linked FRN issued by a UK local authority in the public market. Even given that the market at the time was very disjointed on the run-up to possibly the worst point of the pre-Bank of England action on the liquidity in the markets, the bond was very successfully placed by the lead managing group with a wide range of investors, institutional investors and bank treasuries, mainly in the UK, but also some non-UK investment interest. And the target level of SONIA plus 85 basis points was beaten during the issuance process. So the net cost to the authority was SONIA plus 80 basis points in the end. Now, again, as Christian has pointed out, that represented a substantial saving when compared to PWLB floating rate, and also a substantial saving compared to a PWLB fixed rate loan. But providentially, as we had expected, interest rates continued to decline. So last Friday, we had our first refix, and the cost of the loan fell a further 8.9, I believe, basis points. So having been substantially cheaper than PWLB, it is now even more substantially cheaper than PWLB, which I guess is a proof of concept that pleased us very much. The note in the market has continued to trade pretty much in line with its issuance level, in spite of the machinations of the market over the last 2 to 3 months. So again, that is also a proof of concept that the credit has been accepted by not only the initial investing community, but also other investors. Although we're not aware of substantial secondary trading, a couple of transactions, small transactions, have gone through during the period. So consistency again is demonstrated. I think that covers what we've done with the floating rate market. Now we're looking at stage 2 and stage 3 of our debt management restructuring. So at present, we're in discussions with Christian and June with the possibility of issuing another sole local authority bond, but with a substantially longer maturity and on a fixed rate basis. So we're looking at the 50-year plus sector of the market. When we first discussed this with the lead managing bank group, pricing was a little bit hazy as the liquidity of the market was still suspect. But since March, we've seen a consistent stream of housing-related bond issuance and utility-related bond issuance, which are a reasonable proxy for the UK local authorities. And in all cases, they've come at reasonably tight levels and continue to improve in pricing during the issue process. So I think we're now getting very confident predictions that the target that we set ourselves, which is to issue at an overall cost of maximum 1.5% for 50-year plus issuance, is certainly in view. And actually, with my personal view that the gilt market yields will continue to fall aggressively, we will hope to beat that cost over the next few weeks. So we hope to get a bond into the market in, if not late June, early July, then possibly by the end of July. And again, going with the agency as the document provider, as from our perspective, this is at an administratively very easy and safe route. We, as an authority, have a big borrowing requirement, but we don't have enough internal bandwidth to actually deal with a standalone bond program at the moment. The requirement for legal time and so forth would be onerous, and the bond agency represents a very symbiotic relationship with our borrowing requirement. So we're very pleased to recommend the sort of structure we have done currently, and I will be interested to follow the composite issuance in the future for smaller issuance that maybe we need to do.
With that, I think it's over to Adrian Bell.
Hi. Well, thank you. I don't have a series of graphs to put in front of you, though were you to ask for them, we would certainly happily send them off to you. I think the first thing to say is that the performance of the gilt market over the last 2 years has been surprising, and yields in the gilt market have now got to an all-time historic low. And while it's conceivable that they will improve further from here, they represent very attractive value for borrowers and painfully thin returns for investors. And I think that is one of the important issues that is going on in here. But as the yields on their base gilt portfolio, particularly for longer dated investors like the pension funds, continue to fall, they are increasingly incentivized to go and search out additional yield by buying what they call credit product and what you call local authority bonds. So there is a process of spread contraction going on in the market on higher quality borrowers that are in considerable demand. And quite correctly, we've been talking about housing associations and utilities, and they have been the huge beneficiaries of what's been going on in the market over the last 2 or 3 months, as spreads over gilts and therefore yields on the bonds have come down steadily in this very disturbed and uncertain time. And there is no doubt in my mind, or indeed the investor's mind, that local authorities represent a very good safe haven to put their money into in a period of uncertainty. So that's the first thing I wanted to say. The second thing I wanted to say was, and those investors are searching for liquidity as well as they are searching for a safe haven. And liquidity means bonds that they can trade easily in the aftermarket so that they can always feel capable of readjusting their portfolios as circumstances change. And that takes us to a very simple issue, that to be index eligible, which is what most investors require, deals have to be a minimum of 250 million in size, and in some instances 300 million in size. And to be attractive to big investors, they have to come from organizations that are capable of significant and continuous repeat borrowing. So by coming into the UKMBA, what you are doing is joining a movement that is providing investors with what it is that they want, which is high quality, AA- rated bonds in significant volume that they are able to then trade in the aftermarket. Furthermore, you are using a structure that investors outside the UK are well used to investing in. Most local authorities across Europe borrow through composite borrowing vehicles, whether they're guaranteed by the government, whether they're mutually guaranteed, or whether they have shareholder capital working behind them. It is the preferred mode of borrowing with local authorities in Europe, so that the UKMBA as a concept is entirely familiar to foreign and European investors, and those investors are playing an increasing role in the credit market in the UK. And just to give you an example, whereas on local authority deals, whereas on housing association deals, we used to expect investors to number about 20 or 30 for the whole deal in the UK. When we go out now, we see over 100 investors subscribing, even for long dated issues, and the majority of those will come out of the European and Asian markets rather than simply the UK markets. So in summary, I think you're walking into a vehicle which is going to issue bonds that are in very strong demand, that is capable of issuing significant volume, that is going to be able to issue to investors in the format they want, while making your life easy in terms of a relatively straightforward loan agreement that you can use and reuse time again. And I think that now is a perfect time for you to take advantage of this, to lock into money that is coming at well below 2%. And I just repeat the word well below 2%. 5 years ago, that seemed incredible or almost unbelievable. Today, it's exactly the top end of any borrowing costs that you're likely to face. And could I just then say one thing more? I'm sure you've seen a lot of people suggesting that private placements are a viable alternative, and indeed they are. But all of those private placements are priced including an illiquidity premium for the fact that they can't be traded in the secondary market. That illiquidity premium varies somewhere between 25 and 40 basis points. It's true of the utilities market, it's true of the housing association market, and it will be true of the local authority market. So you come into the UKMBA, you're coming into an inherently cheaper borrowing vehicle than you will get elsewhere, other than with the PWLB, if it ever chooses to change its charging structure again. Thank you.
Thank you, Adrian. Just for a short recap now. We believe the agency's validated its business case. You've heard from Mike, even if you didn't hear from us. We did deliver significant savings for Lancashire. We are readying the 3 bond issues, 10 years, 20 to 25 years, and 40 to 45. PW rate cuts are not certain. It's also worth reiterating, just to echo particularly Adrian's point there and Mike's previously, we are aware that some of the advisors and banks that have been coming around suggesting to you at the moment that, 1.5% of premium to the gilt rate is very attractive. Well, you just heard from Mike and Adrian that it really is not very attractive. And you've seen our pricing earlier. So, you should look at the cheapest option, which at the moment we're confident is the UKMBA. We have new products on offer, such as short-term loans in the near future. The proportional guarantee is much less onerous than the previous joint and several guarantee, and the credit framework of the agency remains robust. So even if you have some residual concerns around the proportional guarantee, the chances are the credit process will deal with them. You can never say never, but certainly some of the authorities that you're likely to be concerned about at the moment will not pass the agency's credit process one way or another. Now with that, I'll throw it back open for questions, which I believe Sir Merrick will moderate.
Thank you very much, Christian and Mike and Adrian. So if you want to ask a question, if it's a sort of short one, then please type that into the chat facility on Zoom at the bottom below the participants. Also, if you want to say something, then please indicate in that, and Vitaly will hopefully connect you up so you can speak to everyone. At the moment, I'm not seeing any questions. Whilst you think if you've got any questions or points you want to make, Christian, did you just want to say, or June, we've got the timetable. You talked about the 8 weeks really leading into an issue. Do you want to say a bit more detail about that? What local authorities have to do when and where in order to get themselves placed to participate?
Yes, I think we've been quite focused on taking advantage of this market, which Mike has certainly been the recipient of. What we would need is really to have an indication in early July of interest. We would need to have the frameworks agreement essentially passed and recognizing some challenges with council's meeting, but taken forward by the first week of August. And then we would need a final commitment in beginning of September. At that point, we would be able to forecast what the exact interest rate would be, so you'd have a very good idea. But we really need to begin to form our pools, whether it's the 10, the 15, the 25, or the 45. So we need to have an expression of interest in in early July, followed by document framework approval.
All right, we've got one question so far from L. Bradford White. I don't know which authority, but the question is, why is it that local authorities continue to borrow from the PWLB and have not changed to the alternative? Right. Who wants to suggest why that might be?
I think it's fair to say that for some local authorities, there hasn't been an alternative to the UKMBA comes along. So I think that's, in the shorter term, that's been the reason. The agency needed to prove it could deliver the saving, and it has. Prior to that, there was not a huge range of alternatives, really, for most authorities.
The PWLB has always represented a very simple process for borrowing, and as Adrian and Christian have pointed out, until the agency was up and running, it may have been a theoretical possibility, and for some bigger local authorities who've looked at individual bond issuance under their own names, it has always been possible, but the mechanics have been either costly or time-consuming. But effectively now there is a pathway developed by the agency going forward. I think Bradford are absolutely right. Why, as long as PWLB don't change their pricing aggressively, why would you do anything different?
Yeah, I guess one concern I've got at the moment is the sort of, jam tomorrow optimism that through the PWLB review and indeed the representations that the LGA and others, and no doubt some of you have made directly to Treasury on that, is a belief that they're going to go back to a sort of pre-last October, where when we had the 1% full 1% rise, going back to that. And none of us can predict what Treasury may choose to do whenever they may choose to do. They might do something tomorrow. They might do something never. Or there may be other reasons for changing interest rate to some extent. But I think my view for local authorities is, if you have a borrowing need now, then you have a choice here, and at some point, you've got to jump. You've got to decide whether you are going to stick with PWLB, hope that the representations from local government are listened to in their entirety, that you can deal with the likely greater constraints that will come through that consultation process, because Treasury doesn't do things by accident. They're clearly trying to constrain what they see as investments for yield. However, that's described in the consultation process, and we know that for many local authorities, it's not really not as simple as that. We know there are a few authorities who have been very aggressive investors in the commercial markets, but for most, this is they may well have commercial investments, but at small scale. But a lot of it is in their own areas where you want to regenerate your town centre, whatever it may be, and certainly you want to make a return from that investment, but that's not the sole and simple driver of your investment. Now, the risk is that the changes that come out, if there are any that come out of PWLB with everything else that's going on at whatever point, may make that extremely difficult for you. The UKMBA is never going to be, it was not set up to be a sort of a lender of last resort for authorities who want to get around whatever the government may be doing. That's never going to happen. We if that's your intention, you're not going to get money from us, from the bond markets. but we know there are very good authorities who have complicated needs that can't easily be defined through consultation process, or sometimes quite constraining controls put on by Treasury. So that is very much our view, is that those authorities that have a need, you've got to decide. There's an opportunity, we believe, here. Mike's experience for Lancashire, Mike has strong views. He's backed those. They've worked very successfully at this given point. No one can guarantee that the same would happen again, but we know that there is strong demand out there in all respects. So we now have a further follow-up. Is there a minimum amount that is required? And other than the costs that you have described, which you've clarified as cheaper than PWLB, is there a further cost to the administrative process described? Oh, thank you, your Hamilton district. Right, Christian, you're going to go on that?
There's no additional administrative costs. What will happen when the agency places the bond is things like the underwriting fees that the banks charge will be folded into the interest rate that you're quoted. So you'll always be quoted, because it's the correct thing to do, effectively your all up cost of finance. So we would expect, say on a 50-year bond issue, there will be something for the agency, because the agency needs to cover its costs, with the lawyers and banks, for example, taking a further basis point. Now that is not money the council themselves has to find, we take it out of the bond issue. So if all the authorities needed 250 million minimum, and say we needed X amount extra to pay the bills, we'll add that onto the bond. That's the easiest way to do it. So there's no extra cost to approving the framework agreement. There's no extra cost for lawyers if you commit to the bond issue. The agency's taking that risk in effect. So really to you, it's all you get is an interest rate that you pay on your loan. And that's the way to think about it. But it's also the accounting requirement as well under IFRS. If anyone is quoting you a rate with separate costs, that's a little bit naughty, to be honest.
Yeah, just from the MBA board point of view, as Christian says, we take a very small margin, and that's to cover our costs. Some of your shareholders, you backed us from the very beginning some years ago. We are, as Christian said at the very beginning, we are not a commercial bank. We are for local government, owned by local government, and one way or another, we will, we pass on the benefits either in tighter costings for you in the rates that you borrow at, or if you're a shareholder, we very much hope that in future years we'll get to a position where we're paying you a dividend on your investment. We're not there yet, but that's certainly where we'd like to be. We are not, as I say, banks or others who are very much commercially minded first and foremost, and who sometimes have very complicated structures in place that the true costs may not actually be very clear or indeed explicable to elected members or others. With us, everything is very transparent. Just going back, then I missed, a question from Wellin, and that was, do you have a document you can share that explains the administrative processes involved? Christian, do you want to do that? We've got a further question.
We will have one up on the website fairly shortly, because we've only just fixed the timescales. In broad terms, the only real administrative processes that affect the council are threefold, and one of them is an ask of the UKMBA. One is to approve the framework agreement, which in most cases will need to go to full council, simply because the constitution in most cases is silent about guarantees. So at least one of the shareholders actually does have guarantees in their constitution, so they were able to avoid taking it to full council. And then there are really only two other steps. One is asking the UKMBA to start credit work on it, so the agency can tell you whether we're comfortable with the credit. And there'll always be a final decision, but we can tell you in advance what's that likely to be. So we wouldn't put you in a position where you go through the public process of approving the framework agreement and we turn straight round and go, sorry, we really don't want to lend to you. We would take care of that in the background beforehand. And then the last stage is actually telling us how much you need to borrow and committing to borrowing that sum in the early bonds. Now, as June said, we'd like greater clarity in July, but we have an absolute cut-off that will be probably the first week of August. And again, that's just simply to allow Moody's to do the credit work. So we will have something up shortly, but the process in terms of administration, Andrew, is actually pretty simple. And there will be templates for approval as well.
Yeah. So we've got a couple of questions that we can roll together. The first one from Debbie P is 250 million per council borrower. No, I can answer that. That's not the case, unless you want, to do issues as the Lancashire have done in your own name, with you guaranteeing it. But for a pooled, that is the total amount of all the authorities coming together. And then the second question from Max Truelove from York and North Yorkshire is, what is the average amount of borrowers you expect in pooled issuances going forward, and what is the maximum amount of borrowers for a pooled issuance? Christian, do you want to do that?
I'll deal with the last one first because that's easier. There's no maximum amount of borrowers, although some of you have heard me quip before. The ideal situation for the agency is all 343 authorities borrowed $1 million each in the first bond, so everyone's part of that. That's actually administratively quite awkward to administer, as you'd appreciate. We think more realistically we'll have in any one issue between 5 and 10 authorities. Over time, as the agency lends more, the number of borrowers in a particular issue actually matters less and less. What matters overall from the agency's perspective is the amount any single authority has borrowed as a proportion of the whole, which are called concentration limits. The agency has limits built in to stop one authority having most of the pool, or any small group of authorities having most of the pool. So we think 5 to 10 in any particular bond issue is likely, but we would take more. Certainly the early ones, we don't want fewer than 5 at the moment, because we need to have proper diversity of risk, and the market will accept that as well.
I think there was also a question, Christian, is whether there was a minimum amount. And I think we can really handle, amounts sort of in the million range. If folks had, a relatively small borrowing to start, recognizing that, as Adrian pointed out, once you use the paperwork, you can use it over and over again. But there's no real minimum size, just enough to make it worth your while to borrow.
Yeah, and I think earlier you touched on him. You have to have the power of general competence to borrow. We've had interest from drainage boards and others, and they can't. On the other hand, we've also had interest from waste authorities, some of whom I think can. So the next question from Andy Stockton on T's is, are there any conditions on what you will loan funds for, debt for yield, ? So I'll just say that before passing to Christian is, our role at the MBA is not to question your use of capital borrowing or to see whether we think that what you're borrowing in is the right thing to do for your authority. That's for you to do through your normal processes. That doesn't mean that we don't want to know what the money is going to be used for, but key to us is your overall financial strength and that you meet our credit criteria. But Christian, do you want to perhaps build on what I've said?
Yes. In some respects, the only condition is that it has to be legal and various. So if the government were to change the regulations around capital expenditure, then you would have to follow that, but you would regardless of the source of finance, whether it's the PWLB, UKMBA, or indeed anybody else. How we look at it essentially is risk-based. So the credit process itself is looking for two main issues across authorities. It's looking for those whose business model is so different from everybody else, they're a different risk. So there's at least one district in the country, and I think arguably 3 or 4, who are really property companies with a small local authority attached. They generally will not be able to borrow through the agency because their credit profile is just very, very distinct. Now, the agency may do a bond for them on their own, but it wouldn't put them inside the pool. So generally, we're not, as Sir Merrick said, we're not taking a judgment, but we cannot quite reasonably have people that are, whose risk is primarily not local authority risk running through the pool programme. Now, that's a judgment call really for the credit analyst doing the work and the agency's board. Beyond that, also then the risks of what you're doing. So if you went into retail today at February's prices, I think again it's unlikely, but we're not going to take a view of you buying town centre shops, for example, primarily for yield but also regeneration. As Sir Merrick said, that's not our game. What we're looking for is those that are unusual and also excessive. So if you were a £50 million income and expenditure authority and you're looking to borrow 500 million for property investment debt for yield, I'm pretty confident I would recommend no if I was doing the credit analysis, simply because if something goes wrong, you can't absorb the hit with the transaction. So we look at that would be clearly in what we would call probably an excessive borrowing, but we don't have a hard limit and we don't sit there trying to distinguish what's good versus bad expenditure. You know, as Merrick said, you're in a far better position to judge that, and it's not an easy trade-off for you. So we're not going to presuppose that you're right or wrong.
Okay, we're nearly at 1 o'clock, so I think just a final call for any last questions or points that anybody wants to raise. Just contacting us. If I don't think we've got a slide with those on, but our internet website is ukmba.org, and you can find our contact details on that should you wish to speak in detail to June and Christian. And I'm sure that if you want to also get in contact with Mike and understand the detail of the process that he and Lancashire went through a couple of months ago now, then please do so. And Adrian made an offer of more sort of market details if you wanted, and certainly if you want to approach through Christian and June, then I'm sure Adrian will be happy to do that from his great experience elsewhere. So thank you for the thank you and very helpful point made. As I say, we are moving clearly through the processes now. If your authority has borrowing needs in September or in that final quarter of the year and want to borrow, then please make contact now. There are, if you're not already a shareholder, if you haven't already taken the framework agreement through your council, particularly in its latest amended form, then there are some things you have to do with within your Treasury procedures, but they are not enormously complicated or difficult, I would say, and I think nigh on 30 councils have already done that, so others are ahead of you in that. And then, of course, there are the processes that have to be gone through with Moody's, and also we're slightly into the summer process. There will be road shows as we operated with Lancashire to inform and assist the markets out there. Christian, June, do you just finally, just for 1 minute, do you just want to say what actually happened when that magic moment that we waited for many years, when in the midst of some disastrous markets and other conditions, just when you opened, how many times we were oversubscribed, how the investors, and perhaps the scale and significance of some of those who participated and their appetite, just so that those in local government can understand the strength and nature of those who actually want to invest in UK municipal authorities.
Well, we were quite pleased. I mean, we had all of our documentation ready, and we're waiting sort of for a market window. This was right in the beginning of March, when things were starting to get a little dicey with COVID. And quite frankly, we took bids for over a little less than 2 hours. At that point, we had 26 different international investors, many in the UK, but some beyond. We were more than 3 times oversubscribed. We had one bidder who asked for all of Mike's bonds. We had to beat him back a bit. So it was very, I think, a very positive experience that we had many more orders than we could place. And interestingly enough to us, some of the feedback was, while we found Mike's bonds really attractive, we're really waiting for the pool deal. So I think if we can give you any encouragement that there are buyers out there who understand the local authority marketplace and would really like to participate in a pooled bond.
Yeah, I think it's worth reiterating just how difficult the market conditions were as well, because you had the crashes were starting and well in progress, and HSBC called it the hit and run of all time, because we were in and out the market in 3 hours from launch to closing, which is almost unprecedented for a first-time issuer like the UKMBA. So we've proven we can do it in very, very difficult market conditions. So we're very confident when we're in better market conditions what we can achieve.
And just finally, what we identified was a real, and this is ongoing, appetite for verifiable green bond at some point. You'll all be aware of the types of products that are out there that are rather greenwashed, that we all know with much of local authority capital borrowing, there are clear environmental improvement benefits that can be verified, and that for future investors could be very attractive, and we would hope to see a price benefit. There's no point in doing it, frankly, unless there's a price benefit, but we think that could be a very interesting product as well. So any from the presenters panel, anything you finally want to say? If not, thank you very much, all those who've participated. Thank you to the, I think, maximum we got to was 31 or 32 councils. Thank you, and please get in contact, and we will, from our part, keep you informed over the next few weeks as we progress towards September, and the fact that we will need you to act if you want to borrow in the next few weeks. Thank you very much. Bye.